All right, everyone, welcome to the NAIOP Southern Nevada June breakfast meeting. My name is Reed Gottesman, and I'm the president-elect, and I'm here to pinch hit for our president, Chaim Mizrahi, today. Good morning to everyone in attendance here at the Orleans and everyone joining by Zoom. As a reminder, the Zoom Q&A will be monitored, so please make sure to submit your questions. And for our attendees in person, you can write down your questions on the notepads provided on the tables. The committee will circulate them and then collect them. Q&A will start at 9 o'clock, and today's program concludes at 9:15. At the beginning of this year, our President Chaim made a commitment to share some lesser-known facts about the chapter and its achievements. Today, I'm going to continue that tradition. But first, a quick recap of what we've covered so far this year. In January, we shared that NAIOP Southern Nevada is a top 10 chapter nationally by member count. This really shows how this chapter punches well above its weight class. In February, we celebrated our Chapter Merit Awards and how this chapter has been winning national awards since 1993. In March, we talked studies that NAIOP has been involved with over the years. These studies, they may sound boring, but they're critical to maintaining the health of our industry. In April, we took a trip down memory lane, hearing about how the Community Service Committee came to be. Last month, we talked about a program that is near and dear to many of us, our Developing Leaders Institute program. Today, I'd like to talk about programs. For me, my involvement in NAIOP programs has been important to my personal development over the years. And I know that one of today's panelists, Adam Malan, I know that Adam would say the same thing as he chaired the committee a number of years ago. So with that, let's talk a little history of our programs dating back to 1986. There's a real evolution story about how our programs got from there to here. And I think Jonna has some pretty cool slides as I tell this evolution story. Our NAIOP Southern Nevada program started way back in 1986 at Chin's Restaurant at the Fashion Show Mall. These programs began life in the form of a cocktail reception. They then moved to the Rio in 1990. Back then, the Rio only had one tower and 3 meeting rooms. They remained at the Rio until 1992. In early 1993, someone had the foresight to change the format from cocktails to a breakfast meeting. These breakfast meetings started at the Hacienda Hotel. They remained at the Hacienda Hotel until mid-1996 when the Hacienda was shuttered. But the Hacienda Hotel did not go down with a whimper. In true Vegas fashion, the closing of the Hacienda became a giant party as the structure was imploded on New Year's Eve 1996. And this implosion, it made room for what is now the Mandalay Bay Resort. With the Hacienda blown up, NAIOP decided to move the breakfast program to Palace Station, where it remained until mid-2000 when the Palace Station was set to undergo a major rehab. Our program soldiered on and moved to the Stardust Hotel, where we remained until the end of 2006. Once again, we were at a hotel that was slated for implosion. For those Las Vegas history buffs, the former Stardust site has been granted a new lease on life and is now the site of Genting Group's Resorts World. When Stardust was shuttered, much of their catering staff moved to our current site, the Orleans. And here we are. NAIOP Southern Nevada has now worked with many of the Orleans staff for more than 20 years. Then COVID happened. We innovated, and that made us even stronger. Now we're back live and with our virtual option, and we have a great program for you today. But first, our President's Circle sponsors. Let's take a moment to honor our President's Circle sponsors. They're a critical component to the success of our chapter. Our Platinum sponsor, special thanks to Cox Business, our Platinum sponsor. Cox has been a supporter of our chapter for 18 years. Our Gold sponsors, we want to thank them, and I'm going to list them. Kimley Hornis and Associates, Spotlight 2022 Engineering Firm of the Year, Majestic Realty Corporation, whose leader, Rod Martin, is a Spotlight Lifetime Achievement Award recipient, Nevada General Construction, Panettone Development Company, Spotlight 2022 Development Firm of the Year, Prologis, Southern Nevada Water Authority, and the Howard Hughes Company. And our remaining President's Circle sponsors, let's recognize them as we look at the screen. Our silver sponsors. Our bronze sponsors. And our copper level President's Circle sponsors. If you are interested in being a 2022 President's Circle sponsor or still need to recommit, please stop at the registration desk for more details. Contact either Katrina or Jonna at the NAIOP office. All right, everyone. NAIOP, it doesn't happen by accident. It runs because we have amazing committees made up of really dedicated volunteers. Let's take a moment and hear our committee updates.
Morning. Jerry Doty with Colliers, co-chair of the bus tour committee. Please save the date, November 10th, for the annual bus tour. It is the same virtual room-to-room format as last year. It is here at the Orleans. We have a really great theme this year, Once Upon a Time. Awesome costumes, awesome room decorations, probably in store. Submissions due June 27th, so I think 2 emails have gone out. Please get your properties submitted as soon as possible. We'll sort through and hopefully a great event this year. Thank you.
Hi, I'm Lauren Wilmore with CBRE here on behalf of the Community Service Committee. If you're not on your phone already, we're going to ask everyone in the room to take their phone out and scan the attached QR code on the screen. Thanks to the help of Teresa Vanuya with Heller Companies, we've made it easy as just a click of a button to donate through the Amazon wish list to this month's cause, Street Teens. Since 2001, Street Teens has been providing life-changing services to homeless, abandoned, and at-risk youth across the valley. We hope that everyone in the room can take part in contributing to their efforts to making a difference in these kids' lives. Thank you for everyone's generous donations to Street Teens so far this month. We are continuing to accept donations in person as well as through June 20th, and there are additional donation lists at the back table. You can reach out to any committee member with questions or for additional information. Also coming up for the month of July, we are partnering with communities and schools for the annual Tie Drive and Scholarship Application Fundraiser. Be on the lookout in your emails for more information. Thank you for all your continued support. It does not go unnoticed, and together we can make a difference.
Good morning. I'm Sam Flaherty. I'm with Encore Landscape Management. I'm the chair of our DLI committee. Our DLI 2023 class will be starting this year in September. So applications are open and they're due on July 8th. So if you are interested in applying, July 8th is the deadline. We've already gotten a few. You get extra bonus points for submitting early, so keep that in mind. We also do need a few sponsorships, I believe. I know one of them is a reception sponsor. So we have a graduation at the end of the class, and as a reception sponsor, you get to attend and be the sponsor of the reception prior to and get to meet and interact with all of the graduates. So if you're interested in applying or sponsoring, you can contact me or the NAIOP office. Thank you.
We also have a representative from Street Teens here today, Brenda, so we just wanted to give her some time to talk about the cause.
First of all, I just really want to thank all of you here today because what you're doing is making a difference there at Street Teens. Right now, we are seeing a record number of our teens that are getting jobs. So with your support, with your help, with the items that you guys collect, it is making a difference there. And on behalf of all of us at Street Teens, we just want to say thank you.
My name is Micah Durham. I'm with Nevada General Construction. I'm here with the membership committee today. We have a handful of different events coming up through the end of the summer. First, we have our Summer Mixer Series, which is coming up on July 14th as well as August 11th. That'll be at Panavino over by the airport. It's a free mixer, members and non-members. There's no hosted bar or anything. It's just a great opportunity for everybody to get together, get to know each other, invite new members and things like that. We also have, again, here at the Orleans, July 28th, our annual bowling tournament. There's still only a handful of teams left. They're 5-person teams, $200 a team. There's also slots for individuals, and we'll place you on a team, $40 a person. We're also doing a raffle that'll benefit the Community Service Committee. That'll be done while the scoring's done. It's going to be a really good time. Again, that's here at the Orleans. And then save the date for our social event of the year in September on the 22nd. It'll be at Diversion Amusements again. If you were there last year, you know it's going to be a really good time. We're going back in time yet again to the 70s this time. It'll be a disco fever theme. It's going to be a lot of fun, a lot of costumes, drinks, great food, and just a really good time. We also have multiple $500 sponsorships for really any of our events right now. For any members that want their company to be able to sponsor an event, $500 branding opportunity. It's going to be a really good time. Back to you, Reed.
All right, Sam, Michael, Lauren, Jerry, you guys are awesome. All our committee chairs, I mean, they do so much, and we really appreciate their hard work and their dedication. Also, a special thank you to our programs committee, led by the amazing Dan Tutlin, who I know is out there somewhere, and also to Chaim Mizrahi, who played a large role in putting today's program together. All right, new members. Every month, we like to recognize our new members. There are a few this month. If you're new, please stand up. Well, there's Mike G. I see Mike G. Welcome. These guys all have red new member ribbons on their name tags, so if you see it, just please welcome them. All right, member push for new members. NAIOP Southern Nevada, like we said, we're 600 members strong and rank in the top 10 nationally. To the guests here today or attending by Zoom who are at NAIOP member, this is your personal invitation to become a member. If you'd like to explore what value NAIOP can bring to you and your company, you have 4 easy options. Thanks to Katrina and Jana. You could stop at the registration table for a membership on your way out, or go right there right now. Go for it. You go online at naiopnv.org and click on membership and follow the steps. For those that still know how to use their phone, you can call the landline at the NAIOP office, 702-798-7194. And we have membership committee members here, and go speak with any of them. We would like to thank our 2022 breakfast meeting sponsors, and I'll list them: Affordable Concepts, Carpenter Sellers Delgado Architects, Cox Business, Dermody Properties, Helix Electric, Heller Companies, NV Energy, Schnitzer Properties, Southern Nevada Water Authority, and SR Construction. And today's sponsor, special thank you to NV Energy. They've been a valuable supporter of the chapter since 2004. And I am pleased to invite Keith Jackson to the stage. He's NV Energy's business development executive and just a gentleman you see at just so many of our industry events. So Keith.
Good morning, everyone. I guess I should start off and thank whoever set up the breakfast venue as far as having fruit. I'm watching my diet, and it was very hard to pass on the bacon. I'll start there. So with that said, we're proud to be a sponsor for NAIOP. We really are. We've been a partner for some time. As you know, we are a constant in the community, and we're here for you. So we have 2,300 employees, valuable employees that support each one of you, including our community. We've been around for about a century. We have 1.5 million customers across 46,000 square miles. Total payroll taxes, this surprised me, $308 million is what we paid 2021, and total paid in taxes for 2021 was $228 million. So I don't know why that was important, but that's what the slide says, so I wanted to get that out there. Economic development is what my team does as far as discovery packages. We put discovery packages together. We do a lot of RFIs and things of that nature to get those companies to come into Nevada. Great experience, right, to support some of those companies that are looking to come here. We have a Nevada site selector, I think, that works for this particular audience, which is NV Energy's economic development team. We provide site locations, GIS-based real estate databases, and an economic development tool to help current and future customers, site consultants, and real estate firms identify perfect locations for your businesses. And we've done this for a couple of years, so if there's anyone in the room that would like to be part of this particular tool, we're happy to support that effort. As far as economic development, electric vehicles, incentives are offered throughout the workplace for fleet charging stations. Commercial energy storage, energy efficiency, connecting developers and new customers with our business energy services. We have a rate estimator that we work with our developers on to determine what your rates are going to be in the future. That's always great when we talk about getting, again, new businesses to come here into Nevada. Where we compare to other states, Nevada averages retail price for industrial customers was 60.7% lower than California and 23.7% lower than the U.S. average. Nevada average retail price for commercial customers was 59.6% lower than California and 31.6% lower than the U.S. average. So we're proud of those numbers, right? So as far as renewables, our company has long understood the benefits of renewable energies and signed our first geothermal contract in 1987. The Senate Bill 358 increased our RPS, Renewable Portfolio Standard, to 50% by 2030, and NV Energy is in position to comply with that standard. In 2020, NV Energy achieved 29%, surpassing the 22% that was expected for RPS. Our current portfolio consists of 57 large commercial, geothermal, solar plus, storage, hydro, wind, biomass, and supported rooftop solar projects, both in services under development. I'm sure most of you have heard of GreenLink, which is a new renewable energy and electrical infrastructure initiative that will make Nevada a leader in clean energy. Move Nevada closer to future powered by 100% renewable energy and reduce Nevada's carbon footprint, generate over $690 million in economic activity and create over 4,000 good-paying jobs. The whole idea was to improve our system reliability and transfer capacity within the state and to other states. Very proud of our electrical vehicle growth for Nevada transportation electrification plan. We're in the process of investing $100 million in the next 3 years to rapidly expand electric vehicle charging stations across our service territory with an emphasis on historically underserved communities. So the transportation sector now accounts for the greatest percentage of greenhouse gas emissions in Nevada. Next slide, please. And so that's my spiel. So again, thank you for allowing us to sponsor you today. It's always great to see all of you, and we're here for you when you need us. So thank you.
All right, Keith, we appreciate it. All right, let's get on with the program now. Reminder, all the tables have pens for Q&A, pens and paper. Our committee members will stroll around and pick these up from each table. And if you're participating on Zoom virtually, there's a Q&A and it will be monitored, and we do look forward to everyone's questions. Q&A will start at 9 o'clock. And today's program will conclude at 9:15. So we're about to get this program started. I am going to now introduce our moderator. It's with great pleasure I introduce Xavier Wasiak. He is the managing director at Jones Lang LaSalle. I did have a big long bio of Xavier, but I will not read that. I'm going to give a few professional highlights and follow that with some personal stuff. Xavier has been a licensed real estate salesperson in Nevada since 1989, and has been with his current company, Jones Lang LaSalle, since 2012. Javier has earned more accolades than we have time to list, but one item I'd like to mention is that he has been a member of NAIOP since 1996. Perhaps Javier is one of the folks in this room that attended NAIOP breakfast at both Palace Station and the Stardust Hotel. I'm very fortunate that I get to collaborate with Javier, and my experience is that he is a tremendous resource and a treasure trove of knowledge. In fact, he's worked with many of the most prominent developers in our valley. He also has a laundry list of major companies that he's represented on the tenant rep side. More importantly, Javier is an extremely youthful grandfather, and he has a 9-year-old son named Parker. Javier really enjoys going out to the desert with Parker where they, in his words, cause trouble, and he likes to participate in activities where he often hurts himself. For those of us that know Javier, we know that these activities include mountain biking and climbing. Also, Javier is a professional grade salsa dancer, so perhaps we can encourage him to show us some moves as we welcome Javier to the stage. Come on up, Javier.
Can anyone hear me all right? So that last part's absolutely not true. Thank you for the height adjustment, yeah. And thank you for allowing me to come up here and moderate this panel. It's an interesting subject. It's a timely subject. Obviously, we've had recent interest rate hikes, and we're all wondering how that's going to affect us. And I'm lucky that I have such a great panel to have that conversation with, and I'll bring them up. I can tell you that the subject is a little bit of a heady subject, so we had our call to kind of go over what we were going to talk today, and I admit, with these panelists, they're all at the top of their game, very smart people. A lot of the conversation, or some of it at the very least, went a little bit over my head. I felt like my furniture looked last weekend, my patio furniture, right? If I have to explain the joke, the wind, remember, it was really bad. Yeah. So today we're going to talk about inflation and rising interest rates and what the impact of that is on commercial real estate investment and sales. So to help me with that, we have Peter Bauman, who is a Senior Director of Institutional Property Advisors, a select division of capital markets experts at Marcus & Millichap that specializes in the sale, purchase, and recapitalization of industrial, medical, office, and retail properties throughout the United States. Peter and his team are focused primarily in the Southwest, though are experts throughout the country. Prior to IPA, he was consistently a top producer for both JLL and Colliers. He also holds his real estate license in both Arizona and Nevada. So Peter, if you can, please come on up. Since I'm getting you one at a time, I'll also ask you, Peter, as you're sitting down, as brokers, we spend a good portion of our days transacting, of course. And among other things, we also spend a good portion of our days talking to our clients, listening, educating, sometimes being educated. Lately, how are you spending most of your day?
Thank you, Xavier. Can you guys all hear me? All right. So, I mean, a little bit about myself, my team. Institutional Property Advisors, you may or may not know, is a division of Marcus & Millichap. Marcus & Millichap's a publicly traded company across the United States and Canada. We've got over 80 offices in the U.S., 2,000 agents. What Institutional Property Advisors does for Marcus & Millichap, it blends the institutional capital with the private capital sector. So on a daily basis, what we're doing is we're talking with institutions and private capital clients and educating them on specific markets across the Southwest, what those economic fundamentals are, why they should be placing capital there, and how to extract and monetize value for office and industrial properties.
Excellent. Our second guest, our second panelist, Adam Malan. Adam Malan is a partner at Logic Commercial Real Estate and offers over 17 years of commercial real estate experience. His focus at Logic is developing and maintaining relationships with private and institutional buyers and sellers on a national scale. Adam's unique strategies and long-term vision have helped investors gain access to unique opportunities, establishing record-setting cap rates and helping shape the retail landscape in Las Vegas. So please, Adam, if you don't mind coming up. And Adam, for you, welcome. I don't know, you guys know who I am, right? Let's put this out here. So our market, obviously, very competitive. That competitive helps drive us be better, sharpen our skills. Lately, with some of the turmoil that we've had, and maybe just the added activity that we've had, what are some of the new or a new tool you've put in your toolkit to help you do what you do?
Hi, thanks for having me this morning. Hope everybody can hear me okay. As far as a new tool in the toolkit, I think more than ever we have national and international, even institutional capital looking at Las Vegas. So I think a new tool in the toolkit for the last several years in the cycle has really been leveraging out of market for inbound investors. We've got a strong stable of high net worth investors locally that have always been active, but I think something new in the last years of this cycle has just been the growing up of our market and the lack of it being some tertiary market that only the risk on investors will look at. We've grown up to where real institutional capital is looking at us, and so I think part of the tools in your bag has to be accessing that.
Right. Thank you. And lastly, Shaun Moothart, who is currently a Senior Vice President at CBRE located in Newport Beach, representing a range of clients from institutional real estate funds to local private capital investors. Shaun and his team customize capital to maximize flexibility and return on investment. With expertise across the major asset classes and capital structures, Shaun's team, in concert with the CBRE Capital Markets platform, offer clients a full range of commercial real estate advisory capabilities. Shaun, if you could please come on up. And Shaun, as you're coming up, I'll ask you, I definitely got from our call yesterday that what you do goes pretty well beyond your bio. How would you describe what you do?
Sure, appreciate it. Everybody hear me okay? So I'm part of a larger team. My partner, Bobby Barra, regretfully couldn't make it here, so I'm a little bit of a last-minute pinch hit for him. He was really looking forward to this event. He resides here in Las Vegas. We have two other partners, one in Phoenix, Bruce Francis, and Doug Burrell up in Salt Lake City, supported by a number of analysts and closers. Our full-time job is debt and equity advisory. So what that means is we're arranging and securing financing for developers and investors across product type spectrum, really throughout the West, very heavy here in the Vegas and the markets that we reside in, but also representing investors across the country as they're looking to expand and grow their portfolios. That's, again, across the product type spectrum, and from a financing standpoint, construction, bridge financing, permanent financing, across all capital sources. There's a lot of different types of capital that's available in the debt space, ranging from the banks and credit unions, life insurance companies, CMBS lenders, pension funds, et cetera. So we're active in that space, and just by way of reference, our team closed in 2,100 financings, and that was done with 68 unique capital sources. So we do our best to try to keep a pulse on the market year in, year out.
Yeah, one of the things I really enjoyed about the conversation we had yesterday, and I think you'll enjoy about the panel, is that we've really collected a group of people to take this issue on in a number of different aspects and from different perspectives. So let's go ahead and dig in. Yesterday, as you know, the Federal Reserve raised its interest rate by 0.75%. It's the largest rate increase in a single meeting in almost 30 years. This after an initial rate increase of 0.25% in March and another of 0.50% in May. Of course, the Federal Reserve does this in an attempt to address rising inflation, which stated in May as being about 8.6%, which is at 40-year highs. It increases interest rates, of course, in an effort to try and slow that inflation down. It costs more for you and I to borrow money and do things. It costs more for businesses to borrow money to do things, expand, grow, purchase real estate. And it also costs more money for investors for them to borrow money and purchase commercial real estate, which in the last 12 months, in industrial anyway, over 11 million square feet of product have been sold, over $2 billion in transactions at an average cost of about $184 a square foot, and that's a rising number. So if we look at the 12 months prior to that, that's about a 30% increase in the average per square foot cost, and if you look at the 12 months prior to that, it's about a 56% increase. So obviously kind of a rising number. And if we were to look at how that's quantified from a total square foot perspective or from a total transactional value perspective, those numbers would be a little misleading just because it's really been bounded by available supply, not demand. And I think that the panelists here will attest to that. So from an investment perspective, Las Vegas seems to be on fire. So to get started, Peter, I'll begin with you. Because of these interest rate hikes, is the commercial real estate investment market in Southern Nevada over as we know it?
I think over is a strong word. No, so Las Vegas through this cycle has really grown up. The economy here is completely diversified from what it once was before. You continue to have inbound migration of new residents on the order of 280 people daily. I see similar comparables to Phoenix. We have 350 people moving there daily. And the Sunbelt states have been the beneficiary of capital placements from institutions, private capital money through the pandemic. And I see no slowdown in the commercial sector here in the Las Vegas market or across the Southwest region. There may be some softening in this interim as interest rates rise, but it's just a cost of capital. It's a mathematical equation that we're working with here. So as the borrowing costs go up, right, we still have strong tenant demand in the markets. Your tenant improvement dollars go up for office renovations, which means your rents are going to go up. So everything kind of rises together, in my opinion. Are the days gone of getting 5 caps and 4 caps and 3 caps? Maybe. That's just a function of what that opportunity is and how quick you can get the rents and set rents back to market. So I'm very bullish on Southwest Nevada or Southern Nevada and the Las Vegas market, and you're going to continue to see spillover capital and migration from the West Coast as those states have different political fundamentals, and it's higher taxation, anti-business. I think to truly see a real slowdown to what's happened in the Southwest markets as a whole in the mountain states, you're going to have to see a complete political shift happen to where these municipalities and these states and this whole entire region is anti-development, anti-growth, and that can happen through new residents coming in, but that's a slow event. That's not an overnight e-break event. What's different now is that that you're still able to borrow money. We're not in a situation where it's
Right.
complete capital constraint. And so that scares me more, because that's what happened in 2008. This is a different event. We need to raise interest rates. We've been in this, hyper low interest rate environment for a decade now. And, people are freaking out that the 10-year Treasury is at 3.4%. Well, we all forget, we're all short-sighted. In 2018, in November, we were banging at 3.25%, and nobody was talking about softening. Cap rates were sliding still on all product types across all sectors, especially in the Southwest.
Yeah, one of the things you said, which I know rings true and very much in industrial anyway, is that the fundamentals are still really strong. I mean, all of us are keenly aware and trying to keep our eye out for signs that things are shifting. And so far, we have very little, if not nothing, to point at to tell us that our economy, our demand, our drivers have shifted at all. And I'll open that to the rest of the panelists too to talk about your perceptions in that question about how our commercial real estate investment market is doing.
I'll jump on that for a second. I mean, I echo what Peter said. I think that the demand drivers for our market and the Southwest in general aren't changing, or the interest rate climate isn't a direct impact on those demand drivers. I think they'll continue. I think we have catalysts locally that'll continue to happen throughout what I feel is going to be more of a price discovery period than a market crash or a market halt, to Peter's point. And as Shaun can attest, I mean, there's capital is out there. The cost of capital is adjusting, and buyers and sellers will need to calibrate to that as well. But demand, as we sit today, remains very strong. We have a lot of assets on the market, ranging from the $3 to $5 million low cap rate single tenant deals up to $70, $100 million multi-tenant deals, and there's active buyers for all of those. Are there as many active buyers at the cap rate sellers want them today versus 3 months ago or 6 months ago? The answer is no. And I think that's because you've got a portion of the participants that are truly in a price discovery mode. If you're not an exchange buyer with a trigger or a fund that's raised capital for a specific purpose and you don't need to buy today, then you're on a little bit of a price discovery look and see. And so I just think that has taken a little bit of the volume out of the market, and therefore it feels slightly different today. But that being said, we're transacting at a strong clip, and we haven't seen much of a move in cap rates despite the shift in interest rates over the last several months.
And Adam, I'll follow up with you a little bit. So we know that, obviously, I mean, industrial's been a bit of a sweetheart for the last few years, and we all understand why that's the case. But I think in the last 12 months, we've seen an uptick in investment activity in retail, of course, a lot of multifamily, hotel as well. Have you seen that? And speak maybe to some of the drivers in retail and what you do specifically as to why that's happening.
Yeah, I mean, I think that the demand for retail in Las Vegas has been all-time for the last couple of years. I think that, the boom-bust, maybe stigma of Las Vegas has worn a little bit. I think that the type of migration that we're seeing has really directly impacted retail sales and retail growth, and I think investors are eyeing that as well. And as I said, opening, I just think our market in general has taken on new legs and has become a little bit more of an institutional market. The type of capital we're seeing is different. The scope of the capital is different. We're out of maybe that period of time where everybody was really sticker shocked from the market events of 2007, 2008, 2009 in Las Vegas. Lenders are more comfortable with Las Vegas. So I just think across the board, our market has grown up and allowed a wider array of capital to look at it.
John?
Yeah, I mean, our world's pretty exciting right now. I would say the good news So I'm not the pessimist on the panel, but I do live in the debt world. The good news is there's plenty of liquidity out there. And as Adam had alluded to, it's just a function of where that price is. Today we're seeing, to kind of give some frame of reference for the audience, we started the year somewhere in the 165, 162 10-year Treasury yield to start on January 3rd. And today we're up to 340. That's almost a 200 basis point increase. That's a very dramatic change. In my almost 20-year career, I haven't seen that dramatic of a change, certainly not in that short of a time period. And so it's going to be interesting. I think we're at a point where when you see that much movement that quickly, especially for those that are lenders out here, you may agree, there's a little bit of a wait and see approach. They tend to be more conservative just generally in nature. And when you have that kind of rapid movement, there's a little bit of pause.
And Shaun, for my benefit, why does that matter? Why does an increased Treasury rate matter?
Sure. So I guess I'll give you a little bit of a case study. We were working on a $35 million loan, and we rate locked with a life insurance company last week on Wednesday, close of business Wednesday. By the time the borrower saw the market on Monday, we had risen 35 basis points on the 10-year Treasury. And so that means they locked their rate 3 or 4 business days prior and had the advantage of 20/20 hindsight watching the market. 35 basis point increase equated on that loan over the term of the 10-year period that they're going to hold that loan was $1.2 million in interest cost savings. That's just one loan, one borrower. There's a tremendous amount of increase in terms of interest costs, and that was just 35 basis points. Back to my original point, we've seen almost a 200 basis point increase since the start of the year. So you can do the math. This stuff adds up pretty quickly and has a pretty dramatic effect on investors' returns. And so that's where I'm, back to, I think we're in this adjustment period. Cap rates haven't moved much. They're starting to move, it seems. Interest rates have moved a lot. And so something's got to give at some level. And I think we're all just in that kind of wait and see approach.
Yeah, one of the reasons I appreciate you being on this panel is you do get to see things from a very different perspective than the rest of us. One of the things you said yesterday on the call that I thought was interesting is how you said that lenders seemed fragmented. So they're not all singing the same tune, just like not all buyers are. But what did you mean by that?
That's right. We're seeing a lot of fragmentation in the market. One of our, part of our process that we pride ourselves on, being at a large platform and having longstanding relationships with a variety of types of lenders, is we go out far and wide and kind of take the leave no stone unturned type approach for our clients. So we're going out to 50, 60, 70 lenders on a specific request, in some cases more, depending on the deal. And we're seeing bids and pricing come back as dramatic as we've probably seen, maybe 150 basis points in difference from the outlier bid to those that are not very competitive. And it's not the same lender every time. It's not the same capital source necessarily every time. And this is, I guess, what keeps us in business, because the market's constantly shifting. But because we're going through so much turmoil, some lenders have a lower cost of capital to begin with, and some may be behind pace in allocations for the year, whatever there's a variety of reasons for that. But there are some, those that are outliers in today's market. Some of them are just lagging behind what the broader market is, and we try to exploit that inefficiency for our clients' benefit.
Yeah, so, over, I want to say about 2 years ago, it seems on the industrial side, again, we started hearing a lot about forward sale activity. And I'm sure most of you know what that is, but for those of you that don't, the short version of it is that investors, developers, saw how tight the market was, lack of opportunities out there to purchase, Class A, specifically investment product, and said, okay, well, maybe we can get in front of these developers prior to them finishing their projects, maybe sometimes even prior to them starting their projects, and we'll make them an offer. We'll agree to purchase the property, we'll take up some of the lease-up risk, and hope that maybe we can get ahead of some of these transactions. And it became very popular, and it really drove pricing, and boy, it was working out with everyone. I mean, for everyone. Just kind of an example on a transaction we were involved with. What surprised me about it is how far ahead of the game the transaction started, where you had somebody who was in a great land position, but maybe didn't have permits. Maybe they didn't even have their zoning in place, and was basically able to go out to the market, get a lot of activity, got real frothy. Great deal. They're going to make a ton of money off of it. The underwriting they did for lease rates wound up being by now 20-25% less than what market is. So everybody did real well. I can tell you that today that forward activity has, come to, I won't say an absolute halt, but it seems one segment of the investment market that's getting impacted the most. In addition to that, if you want to speak about that or other segments of the investment market, who's more susceptible? What product types are maybe more susceptible to these interest rate hikes? To anyone on the panel.
Well, it's a function of yield, right? So people don't want to be in a negative levered position or negative cash-on-cash return position when they're buying an investment property. So as we all know, industrial has become the limelight or the darling of the capital markets since the pandemic, with so many companies going direct to consumer through e-commerce, and Vegas being a massive spillover market from the Inland Empire and Los Angeles, and continued growth in that sector. If you're financing a project and you're selling it at a 4% return, your interest rate's at, say, a 5.5% fixed over a period of time, that doesn't make sense to that borrowed investor. But with what Adam was speaking to, there's still plenty of cash purchasers out there, private capital purchasers, motivated purchasers through tax-deferred exchanges that they don't need that borrowing today, and they can hold that. They've got different motivating factors that you still will find those opportunities out there. There still will be those buyers, but that comes with selecting the right team on the field that has access to that capital source, that actually casts the wide net, that can attract that capital to that opportunity. Where I think the value in a rising interest rate environment, you look at office properties during the pandemic, nobody knew what was going on. In Phoenix, it was like a 2-month halt. Vegas was probably fairly similar, maybe a little bit longer. But still, the return to work has been a challenge, right? There's some companies that have said we're not returning to the office. There's others that are in a, kind of, part-time office, part-time home, very flexible schedule. And then the other issue is you get the millennial generation and the Gen Z generation that the pendulum swung away from the employer demanding what the workforce does to the workforce demanding what the employer do, right? And so until that paradigm shifts, where there's such a labor shortage that you have employees saying, I will not take this job unless I have a flexible schedule where I can work from home 3 days a week, right? And so until that swings back, you're going to see this fluctuated environment in the office sector for a period of time. Now you put that's more across the country. You look at Vegas, right? You have continued migration, continued businesses coming in, so you're not going to experience that as much. But where I'm going with this is that office properties have been not so in the limelight since the pandemic because of these occupancy, I don't want to call them issues, but items, right? Like office rents are still collected at, 99 to 100% on assets. So whether the tenant's occupying the space or not, they're still leasing the space. So the income's still coming in. So it's kind of like a false perception on an investment, right? It's a math equation for somebody on the return profile. So you're seeing softening from the pandemic, and post-pandemic still in the office sector. And so as interest rates go to 6%, you can buy office properties in the 7% interest or 7% cap rate to 9% cap rate or higher, not just in this market but across the whole region. So that when you're looking at an industrial property as an investor, saying, well, I can park my money here at a 5% return, or I can go park my money over here at an 8% return, and my borrowing cost is here, I think you're going to see more flight to capital to the opportunities that have just higher cap rates by a function of what the borrowing cost is.
Yeah, I mean, it seems like the pause that some are experiencing, certainly there's uncertainty, and that's driving that some, but, where, if any, are you feeling that pause, both from Adam and Shaun? Is it, what are your sellers telling you?
I mean, sellers in general have been, punching above weight, maybe is a way to put it. But, I think the interest rate environment that we've been in for the last several years has allowed values to increase commensurate with the low borrowing cost. And so I think from a general standpoint, you have sellers that have been at all-time highs for the last several years that are generally slow to adjust, right? And then you've got buyers who haven't had much of a viable place in the conversation for a few years. The market's been so hot that as a buyer, if you were putting up too many objections or unwilling to pay the cap rates necessary, it was easy for a seller to move on to the next buyer. So I just think we're entering this period of time where you've got buyers who have a more viable leg to the conversation these days, and they're happy to be able to voice that. And you've got sellers who, some of which were only sellers because the market had gotten so frothy for them that they thought, I've got to get in and take some chips off the table. So, it'll be interesting to see if those sellers are still sellers as the market slides, or if some properties come off the market and wait. It's an interesting paradigm because a lot of these sellers will have debt that comes due in the next 5 years. So, who gets to take that bullet in terms of, do I sell now at the values that I can get, or do I wait and deal with the debt market that I'll be in on refi in the next period of time? So, I think that it boils me back down to, we've entered a market where the transactions that are happening are the ones that are driven by a need on either side, whether it's a need for a seller or whether it's an exchange driven, or, I call it hot money, but just fund money that's been raised for a purpose that needs to either find a home or go back to investors. Those are the transactions that I see happening more these days. And frankly, in my world with retail, the low cap rate single tenant deals are mainly cash, and they're coming from family exchange type money, or that hot money that needs to find a home. And it's typically generational money, to where those buyers have had to be comfortable playing with the conditions on the field. They don't have the luxury of packing up their toys and going home and deciding to come play when it's sunny outside. So those transactions are happening, and largely on the trophy, real Class A retail, you've got a buyer pool who can adjust equity allocations and transact. Where I'm seeing the biggest pain on my side is everything in the middle that was happening largely because it was debt, helped, if you will. I mean, the low interest rates were helping both sides of those transactions. They were allowing sellers to overachieve, and they were allowing buyers to push and get there and still maintain cash flows. So that middle of the market is where I'm seeing the most pain.
Yeah, so there's always going to be interest and activity on that Class A side. And even though you might have a reduced pool of buyers, you have buyers. Everyone's just trying to figure out their own individual strategies.
Correct.
Have you guys seen an increase in supply of listings for sellers that want to get out in front of this uncertainty that, they've clipped 80% IRR, and they're like, hey, now we're at 70, 75, 65, whatever it is. We still made a killing on this deal. Let's get out now while we can before who knows what's coming.
We have. I mean, we've probably put $100 million or more across 3 or 4 assets on the market in the last 30 days. And, the conversation in all those cases is this would have been a better move 6 months ago, right?
Yeah, our BOV, broker opinion of value activity, has never been higher. We're evaluating like 50 assets a week and educating. People have been coming back to us where we've given them valuations a quarter ago saying, hey, are these numbers still viable? We're like, well, no, they're not. Here's why. And just showing how the capital cost adjustments affect what the values are of the projects. But I also go back to, like, is there true softening? The investment community as a whole has gotten so used to a wide spread of where their cost of capital was to where they're issuing their money. And at some point, I think when you see these incremental events happen, like a 50 basis point rate hike, a 75 basis point rate hike, the institutions move first. They immediately go pencils down, or they go softer on assets. Your private capital community is still going to be active. They've got a different mindset, a different business plan in place. And at some point, that equilibrium manages itself out where people adjust to a lower spread from their cap rate to cost of capital. I mean, the tightest I've seen it in the last 20 years was back in 2007, and we're still wide of that by a good 50 to 100 basis points. So people forget at the spread level that they were once willing to agree to where they are placing capital today.
I'm conscious of time, and that sucks because I feel like we just began our conversation. It just seems like we could keep going on this for a while.
We can talk about this for 4 hours.
And get a lot out of it.
Javier, we have a little more time for your questions.
Okay. I did want to ask you, so, from what I understand, it's very likely the Fed could continue to raise interest rates, right, throughout at least the end of the year. So if you, as best you can, prognosticate what that looks like. How long are we, and I know it's all related to, they're trying to control inflation, which is a threat, of course, but how long are we in this? Is this period of increasing interest rates? And I know you might have to get out of a comfort zone there, but how long does it last?
Interest rates are going up. They're going to continue to go up until we combat inflation. We've had free money for so long in our economy. What's interesting is that the economic fundamentals are still sound. So I don't know what equilibrium. I'm not an economist. I'm not going to act like an economist. But, I mean, the Fed funds rate benchmark has always been targeted around 2.5%. Shaun, I don't even believe we're there yet today. And, right, like, general borrowing costs, historically, if you look over a wider period, in my opinion, I think, if the 10-year Treasury is floating around 4.5% or 5%, I think that's probably healthy for the United States, right? What's that translate into, an interest rate? There's different curves, and I'll let Shaun talk more about that because he's the expert there. But there's going to be a spread above whatever that is to what your interest rate is on your debt placement.
Yeah, I would echo that. I mean, I think that you showed a really interesting slide on our call yesterday that just showed and forgive me, this is your world, but, it kind of showed the Fed rate normalizing mid-23 or so. And to Peter's point, normalizing to historically probably a below average rate. And so, I think that what crosses my mind is just how short of memories our markets generally have. If you look at history or even the short view of history, the sky was falling in March of 20, right? By March of 21, everybody had a whole different outlook and it was gas on, right? Here we are in March or May of 20, June of 22, and, the clouds are starting to come around again. But to me, I feel like there's demand drivers for our market that aren't going away. The inbound migration is going to be a function of alternatives, and we're still going to be attractive as the boats rise, as inflation raises everything for everybody. So in my opinion, I think things are going to normalize. Buyers and sellers are going to figure out that medium again, and the demand for our market isn't going anywhere.
And I'd argue Vegas is well positioned in an inflationary environment because, it's going to cost even more money in California and Washington and other states, and people are going to come here for the lower, it's lifestyle, it's climate, right, economic base. I mean, the fundamentals here, I find that people that reside in markets sometimes have too narrow of a view of their own market and perception and what's happened in the past. And when you take a wider view and you look around you at what's going on in surrounding states and what property values are there, what's it cost to live there, and then you compare it to your market, Vegas is going to continue to be a beneficiary for a period of time. I see the Las Vegas office and industrial market continuing for the next 3 to 5 year horizon before there's like a true kind of slowdown. And I don't think cap rates are softening. I think cap rates are normalizing.
Javier, on that subject, somebody came in with the Phoenix question for all of you. We often get compared to Phoenix, contrast, compared this and that, sometimes losing. If you could each answer or give your opinion on us and Phoenix in your respective markets, that was the question that came in.
You said just what is the difference?
What do you see in your line of work, the difference between Vegas and Phoenix?
I see very similar fundamentals, other than Phoenix has a larger population base. What I like about Phoenix from an investment strategy and play, and what I communicate to investors on a regular basis when I'm selling property here, I've got 4 assets in the market currently. What I like about Vegas is it is land constraint, right? Like, this is an island in the desert. A lot of people don't realize that.
Yeah, we don't enjoy it as much.
And Phoenix, right? Phoenix can sprawl. A lot of people say, oh no, you've got this mountain range or this or that, but at the end of the day, Phoenix has plenty of land, which is a good thing and a bad thing. But right, the good thing is that you can continue to development and grow, and it keeps costs down. But the problem is that you're never going to get infill densification. Phoenix will always be a sprawling environment. I could see Las Vegas getting much more dense over the next 10-year or 20-year horizon because you are land constrained, right? And that's going to benefit everybody in this room.
Yeah, please go ahead.
Yeah,
Shaun?
No, on my side, I would say the same. From what I'm seeing at a macro level is that it feels like I see a lot of flight to development opportunities in Phoenix and in Arizona. The land market here has gotten so frothy and what have you. So I've heard a lot of success stories about guys going to Phoenix and having a different world in terms of land availability and opportunities to develop. And at the same time, I get a lot more inbound investors looking at Vegas over Phoenix, or even Phoenix investors coming to Vegas. So I think the investment perception has always been maybe a longer runway and bigger upside potential here in Las Vegas. That may be shifting, that may be changing, but I do see a lot of development shifting to the Arizona market, just maybe based on land availability and opportunity.
Yeah, and I think there'll be a slowdown in that. Land values for industrial land development has gone bonkers, just like here. But to give you an idea, something that's like an infill piece that we have right now, 24 acres, you can't get to it for 2.5 years. It's $35 a land square foot. That's a big number. You got to underwrite some pretty hefty industrial rents to make that pencil. There's another piece that traded at $45 a land foot. Now, as you move further out west and you move into like frontier land out by Buckeye in the Phoenix market, where there's no utilities, no water, nothing, no resources pulled, that's trading around like $3 a foot. But if you're back in around like the 10 and the 303 loop, all that's going for, if you can find a piece, name your price, it's $20 a foot's getting turned down, $25 a foot's getting turned down. So
how big of it? Like what was that 2 years ago or 1 year ago? I know here in Vegas you could.
Well, so what's crazy about Phoenix, and I don't know what the numbers are here in Vegas for the industrial development specifically, but in Phoenix, prior to the pandemic, on average, there's 5 million to 10 million square feet of industrial product, right? In 2022 alone, we're going to deliver over 40 million square feet of industrial property in Phoenix alone, and 90% of that will be pre-leased. And so that is all growth spillover from the Inland Empire and Los Angeles, getting product out of the Port of Long Beach and LA, no different than what's happening here with Vegas, right? You guys are experiencing the same thing on the industrial front. And right, is the Inland Empire's industrial vacancy rate is sub 1%. There's no space there, right? And then you come to Vegas, it's sub 2%. Phoenix, you're like sub 2.5%, and the majority of all the available developable land has been completely. The land run has happened, right? So the land gold rush happened from the pandemic to present. Now it'll be interesting to see what happens to that cycle.
Yeah, I mean, I'll add that, both markets have a really good story to tell. So as you guys know, when we're pitching these projects and we're talking with the numerous buyers who are chasing them, we're telling the story. And both markets have great stories to tell. They're just slightly different. Some of the drivers are different. It is true that because our rent growth has been more aggressive, I would say, than it has been in Phoenix, we're probably going to lose out on some occupiers. So some of our demand, will lose to Phoenix, and then that's today, and that'll probably remain for a few years.
What's the drive time from Port LA? 4.5 hours to Vegas?
Not even.
Not even, right? So that's an advantage that the Vegas market has that Phoenix doesn't, right? On the furthest west side where the 303 loop is in the Phoenix metropolitan area, coming out of the port to get there, that's a 6.5, 7 hour drive. For them to offload, turn around and get back in the federally regulated drive time, it's tight, right? And so I think that on the industrial front, Vegas will continue to remain, in my opinion, a stronger investment market from a capital outlay perspective.
And there's just
if I was the investor, right?
Yeah. And there's just less opportunities here, like you alluded to.
Scarcity.
Phoenix is 2.5 times, depending where you start counting the size of our market.
That's a trend.
Would we have 40 million feet going up?
Yes.
It would be an interesting problem to have.
You'd have more than
Yeah.
you would get more. You would get more of those projects. Phoenix would lose because the drive time's shorter.
Yeah, I think we would have to potentially cope more with the threat of overbuilding if we had, because there's been so much demand. I think we'd have to really navigate that a little bit more.
But as it relates to capital markets, investor demand, that investor demand is still tremendous. There's been more capital and more funds and more people interested in commercial real estate as an asset class and way to make money than any other securities. I mean, you all check your 401k account, your stock market account, like they just keep getting beat up. And the more that continues to happen, the more capital that flows into real estate. Real estate will continue to be a great hedge on inflation. And, we're still supply limited. There's not a ton of commercial product supply out in the market.
Shaun, if the deal's the same, would your money rather be in Phoenix or Las Vegas? All else being equal.
Ooh, that's a
Shaun, you're in Las Vegas.
That's a good question. What's that?
No.
Yeah, I guess Las Vegas. I would just add that both are, heavy growth markets, and given the increase in interest rates that we've been talking about, the topic, if you're a borrower or lender, if you're in the market, the term negative leverage often comes up when your interest cost of debt capital is higher than your going in cap rate. It's negative for a period of time. Given we haven't seen cap rate movement as significant, not even close to what we've seen on the interest rate side of things, a lot more buyers are having to take on negative lev situation, at least going in. And when we're in a heavy growth market like we are here in Vegas and in Phoenix, and you have a path, you're not locked into a fixed rent for any length of period of time, but you have a path. You can get after some roll or whatever it may be, some upside. You can get out of that negative leverage situation pretty quick and start to make your returns look pretty darn good, right? So I think given the current debt markets, that may even make Vegas and Phoenix and other high growth markets look all that much more attractive.
And Adam, it's kind of the same question. What's the difference between a Dutch Boys here or a Dutch Boys in Phoenix or any triple net lease for your clients?
Cap rate wise, we're fairly similar. We probably trend up to 25 basis points better on some of those deals, but give you an example, I'm closing a Dutch Brothers in town here tomorrow at a 3.9 cap. That same deal probably sells between a 4 and a 4.25 in Phoenix.
I would say too that the income tax free advantage of being in the state of Nevada for those private capital players is huge.
Yeah.
Phoenix doesn't. I mean, we have income tax, so that's a negative check mark.
100%, especially with these exchange investors going into those low cap rate deals. I mean, every little bit helps, and I think that if the same deal was sitting in Vegas and in Phoenix, the Vegas deal would sell hands down faster.
Javier, I think that's it from here. There's a little known fact that Javier and I went to St. Anne's Catholic Grade School here in Las Vegas.
It's true.
Couple days ago.
It's true, and I since you brought it up, man, I'm sorry, it's your fault. Dan's thing, which
Oh, geez, I didn't bring this up.
yeah, all the girls loved in grade school is he was one of those two polo shirt wearing guys at the same time with the collars up. We all remember, right? Yeah. So that was Dan. Yeah.
Gonna need a picture.
Well, thank you very much.
Javier, Peter, Adam, Shaun, great job, great panel. I think we're leaving here with a little more knowledge than we came. Keith Jackson, NV Energy, thank you so much. And our next breakfast is July 21st. And that concludes today's program. Thank you, everybody.